Every country on Earth carries debt. The United States owes over $38 trillion. Japan owes trillions. Globally, total debt exceeds $300 trillion, nearly 3 times the size of the entire world economy. But here's the question nobody asks. If everyone owes money, who exactly is owed? When you follow the chain of creditors, when you look at who holds government bonds, pension funds, central banks, and financial institutions, something surprising appears. The world largely owes money to itself. Governments owe investors. Investors are pension funds, banks, insurance companies, often funded by ordinary people's savings. So why does the system feel impossible to escape? Because over centuries, financial innovations reshaped how governments borrow. These changes didn't happen overnight. They evolved during moments of war, crisis, and economic pressure. And one of the most important turning points happened in 1694. Before that time, kings borrowed the old way. They took loans from wealthy merchants or nobles. If they couldn't repay, they defaulted. Lenders lost money. Debt was temporary. It either got repaid or wiped out. But during a costly war with France, England faced a crisis. The crown needed massive funding. Traditional lenders were hesitant. Confidence was low. That's when a new idea emerged. A group of merchants would lend a large sum to the government. Instead of demanding repayment of the principal in the short term, the government would commit to paying interest regularly, funded through taxation. To manage this arrangement, a new institution was formed, the Bank of England. This was a major shift. Instead of debt being temporary, it became ongoing. Instead of loans being personal agreements, they became structured financial instruments. Instead of clearing the system through default, governments could refinance, roll over, and extend obligations over time. This wasn't a hidden plot. It was a financial innovation that helped fund wars, build infrastructure, and expand economies. But it also created something new, a world where government debt rarely disappears. It gets refinanced, extended, restructured, but almost never fully repaid. And once you understand that shift, you start to see why modern debt levels aren't treated as emergencies to eliminate, but as structural features of the global financial system. The question isn't simply how do we pay it off? The deeper question is, was it ever designed to be paid off at all? But here's the crucial point. The government never repaid the principal. The loan was permanent. Why would merchants accept this? Because the interest was guaranteed by Parliament. It was backed by the government's power to tax. As long as England could collect taxes, the interest would keep flowing. The banknotes the lenders received in exchange for their gold could be traded. They were as good as money, better than money, because they earned interest. Parliament approved Paterson's plan in 1694, and the Bank of England was officially chartered. Merchants contributed their gold, the government secured its war funding, and for the first time, national debt became permanent. Not a problem to solve, but a feature of the system. Here's what's often overlooked about why this was brilliant for bankers. The government paid 8% interest annually on £1.2 million. That's £96,000 every year, forever. The merchants had essentially bought an annuity from the government. As long as England existed and could tax its citizens, the money flowed, and if they wanted their gold back, they could simply sell the banknotes to someone else. The debt was transferable, but never repayable. Paterson's real genius came next. The Bank of England got the right to issue banknotes backed by government debt. They could print paper money up to the loan's value. This turned debt into money. The government's IOU became currency. The more the government borrowed, the more money could be created. This became the template. The government borrows, never repays the principal, pays interest forever, and the debt itself becomes money. Brilliant for bankers, disastrous for taxpayers, because the public pays interest on debt that will never disappear. Within 50 years, every major European power copied the system. France created the Bond Général, the Netherlands, already having advanced banking, formalized government debt issuance. By 1790, the newly independent United States adopted the same model. Alexander Hamilton explicitly modeled America's financial system on the Bank of England. Permanent debt, interest paid from taxes, bonds traded as currency. Paterson died in 1719, not especially wealthy, despite founding the Bank of England, yet the system he built still exists 331 years later. The Bank of England continues to operate to this day. British government debt has never been fully paid off. It has been refinanced, rolled over, and expanded, but never eliminated. The debt trap was set in 1694, and every government since has walked right into it. By the early 1800s, European governments fully embraced debt. They borrowed for wars, infrastructure, and everyday expenses. But there was no organized market. Each loan was negotiated individually, interest rates varied wildly, and only the wealthiest merchants could participate. Nathan Rothschild changed all of that. He industrialized sovereign debt. The Rothschild family began as money changers and traders in Frankfurt. By 1800, the 5 Rothschild brothers had set up banking houses in 5 major European cities: London, Paris, Frankfurt, Vienna, and Naples. This network was unprecedented. They could move money across borders faster than anyone else, and they used this to dominate sovereign debt issuance. Nathan Rothschild in London was the strategic genius. During the Napoleonic Wars, he arranged loans for Britain, but his real innovation was how he structured them. Instead of lending directly to the government, he bought government bonds at a discount and resold them to investors at a markup. He created a secondary market. The government got money immediately. Rothschild collected the spread, and investors got a tradable asset. Here's where it gets darker. Rothschild didn't just finance governments. He positioned himself so governments had no choice but to rely on him. In 1815, at the Battle of Waterloo, Nathan Rothschild famously learned of Napoleon's defeat before anyone else in London. His courier network was faster than official channels. He used this information to manipulate the bond market. First, he sold British bonds, signaling that Britain was losing. Prices collapsed. Other investors panicked and sold. Then, after prices crashed, Rothschild bought massive quantities at rock-bottom prices. When news of British victory arrived the next day, bond prices surged. Rothschild made millions, not from insider trading as we'd call it today, but from controlling information and market timing. This established the Rothschild model: control the information, control the issuance, control the market. By 1820, the Rothschilds dominated European sovereign debt. If a government needed to borrow, they went through the Rothschilds because the Rothschilds controlled the investor network. They had the distribution and set the terms. Here's why this matters for the debt trap. Before Rothschild, governments could theoretically refuse to pay. If a king defaulted, creditors lost money and the system reset. But Rothschild made sovereign debt tradable across borders. A British bond could be owned by a French investor, sold to a German bank, and used as collateral for a loan to an Austrian aristocrat. The web of ownership became so complex that defaulting wasn't just refusing one creditor, it meant collapsing an entire international financial network. This is the Rothschild innovation: make debt so interconnected that default becomes impossible, not because governments were responsible, but because default would trigger systemic collapse. Governments became trapped, they had to keep paying, and they had to keep borrowing to cover interest on old debts. The debt trap was no longer just permanent, it was inescapable. The Rothschild family's wealth peaked in the mid-1800s. They were the richest family in the world, wealthier than any king, and that wealth came from one source: interest on sovereign debt. They didn't produce anything or build anything, they lent money to governments and collected interest forever. The system Paterson created in 1694 was industrialized by Rothschild by 1815, and every European government was caught. By 1900, America was becoming an economic powerhouse, but it still had a primitive financial system. Banks operated independently, money supply was tied to gold, and there was no central mechanism to manage debt. JP Morgan changed that, not for the public good, but to protect his banking empire. In 1907, a financial panic hit, stock prices crashed, banks failed, and the economy froze. JP Morgan personally organized a bailout. He gathered the major New York bankers in his library, locked the doors, and forced them to pledge their own money to stabilize failing banks. It worked. The panic ended, and Morgan became the de facto central banker of America. But he was 70 years old. He knew he couldn't do it again. So Morgan and his associates, the most powerful bankers in America, designed a permanent solution: a central bank. But Americans hated central banks. The first and second banks of the United States had been shut down by populist opposition. So Morgan's group disguised it. In 1910, Morgan's associates, including Senator Nelson Aldrich and representatives from the largest banks, held a secret meeting on Jekyll Island, Georgia. For 9 days, they designed the structure of what would become the Federal Reserve System. The meetings were secret because if the public discovered that bankers were designing the nation's monetary system, there would have been outrage. The plan was brilliant political manipulation. The Federal Reserve wouldn't be called a central bank, it would be the Federal Reserve System. It wouldn't be one institution, it would be 12 regional banks. It wouldn't be controlled by Wall Street, it would appear overseen by a board of governors appointed by the president. It looked decentralized, democratic, and public, but the structure ensured banker control. The regional Federal Reserve banks were privately owned by member banks, which elected the boards of the regional feds. The regional feds then elected the Federal Reserve Board. The government appointed some members, but bankers controlled the system. The most important power, the power to create money and buy government bonds, was given to the Federal Reserve Bank of New York, controlled by the largest Wall Street banks, including Morgan's banks. The Federal Reserve Act passed Congress in December 1913, largely because most representatives didn't understand what they were voting for. Immediately, the debt trap expanded. Now, the government didn't just borrow from banks, it borrowed from the Federal Reserve, which could create money to buy bonds. This meant unlimited demand for government debt. Here's why this matters. Before the Federal Reserve, there was a limit to how much the government could borrow. Banks only had so much money to lend, but the Federal Reserve could create money by purchasing government bonds. The government issues a bond, the Fed buys it with newly created money, the government spends the money, the debt goes onto the Fed's balance sheet, backed only by the promise that taxpayers will service it forever. This is the mechanism that enables infinite debt. The Federal Reserve ensures there's always a buyer for government bonds, so the government never has to stop borrowing. It can roll over debt forever because the Fed will always buy it, and the interest payments flow from taxpayers to the banks that own the Federal Reserve System. Morgan died in 1913, the same year the Federal Reserve was created, but his legacy is the structure that makes the current 38 trillion US dollars. Debt possible. Without the Fed, the government couldn't borrow at this scale, the market couldn't support it, but with the Fed as a guaranteed buyer, there's no limit. The debt trap became infinite. By the 1970s, the debt trap Paterson, Rothschild, and Morgan built was functioning globally. Every developed nation borrowed, rolled over debt, and paid interest. But developing nations were different. They borrowed for infrastructure, and many couldn't keep up with payments. The debt trap was reaching its limits until Paul Volcker made it permanent. Volcker was Federal Reserve Chairman from 1979 to 1987. He faced a problem. Inflation was over 10%, US credibility was eroding, and foreign governments were losing faith in the dollar. He needed to stop inflation, even if it meant causing a recession. So in 1979, Volcker raised interest rates dramatically. The federal funds rate went from 11% to 20%, the highest in American history. This crushed inflation, but it had another effect. Developing nations had borrowed billions in dollars during the 1970s when rates were low. Now those loans were due and interest rates had tripled. Mexico owed $80 billion, Brazil $60 billion, Argentina $40 billion, and they couldn't pay. The interest alone exceeded their export revenues. In August 1982, Mexico announced it couldn't make payments. Default. This should have triggered global financial collapse. American banks had lent most of that money. If Mexico defaulted, Citibank, Bank of America, Chase Manhattan, all would take massive losses. Some might fail. The entire banking system was at risk. Volcker could have let it happen, let the banks take losses, let the market clear. But he didn't. Instead, he orchestrated a bailout through the International Monetary Fund, IMF. The IMF lent money to Mexico, Brazil, Argentina, and others, enough to keep paying interest to American banks. These loans were called structural adjustment loans, and they came with brutal conditions. Governments had to cut spending, privatize state assets, open markets to foreign investment, devalue currencies, basically surrender their economic sovereignty in exchange for the money to keep paying interest. Here's the key. IMF loans didn't reduce debt, they just rolled it over, made it manageable, but permanent. This is the Volcker innovation. When debt becomes unpayable, don't forgive it, restructure it, lend enough to keep interest flowing, and extract political and economic concessions in return. The debt trap became a tool of control. Countries that couldn't pay were forced to open their economies, sell assets, and submit to foreign economic policies in exchange for staying in debt. This pattern has repeated for 40 years. Greece in 2010, Argentina in 2001, Sri Lanka in 2022. Every time the same structure, IMF loans to keep paying interest, austerity imposed, sovereignty surrendered, debt never eliminated, just restructured and made perpetual. Volcker died in 2019, but his legacy is the mechanism that ensures the debt trap is global and inescapable. Even when countries can't pay, they're not allowed to default. They're refinanced into permanent indebtedness, and the interest keeps flowing to the creditors. The same banks, same institutions, same system Paterson created in 1694. Now let me show you how these four architects built a system where debt is infinite and escape is impossible. Start with Paterson's model. Government borrows, pays interest forever, never repays principal. Add Rothschild's innovation, make the debt tradable globally, so default collapses the system. Add Morgan's mechanism. Central banks create money to buy government bonds, unlimited demand. Governments can always borrow more. Add Volcker's trap. When countries can't pay, restructure, don't forgive, keep the interest flowing. The result is what we have today, $315 trillion in global debt. Government debt, corporate debt, household debt, none of it will ever be repaid. All of it pays interest, and all of it is connected through the financial system. Default anywhere threatens collapse everywhere. Here's the specific mechanism. The US government issues $38 trillion in debt. Who owns it? About $20 trillion is held by the American public, pension funds, mutual funds, insurance companies, banks, and the Federal Reserve. These institutions buy treasury bonds because they're considered safe assets, but they pay interest, about $1 trillion per year. That interest comes from taxes. Taxpayers send money to the government sends it to bondholders. Most bondholders are institutions owned by the wealthy. It's a transfer from workers to capital every year, forever. The other $18 trillion is owed to the government itself, Social Security and Medicare trust funds. The government borrowed from these programs and spent the money. Now it owes itself, but ultimately taxpayers owe it. When Social Security redeems those bonds, the government must raise taxes or borrow more to pay. It's a shell game, but the interest flows regardless. Now scale it globally. Japan owes $9 trillion, mostly to Japanese institutions in the Bank of Japan. Europe owes $14 trillion, mostly to European banks, and the ECB. China owes significant domestic debt held by state banks. Every country runs the same system, and they're all interconnected. Japan holds US treasuries. The US holds European bonds through the IMF. Europe holds developing nation debt through the World Bank. It's circular. Everyone owes everyone, and the interest flows upward to the institutions managing the debt. Here's why this can never end. If the US paid off its $38 trillion, the money supply would collapse. Dollars are created when the government borrows. Paying off the debt would make those dollars disappear, causing deflation, depression, and economic collapse. The government can never pay it off. It must keep borrowing, rolling over debt, and paying interest. Globally, if every government repaid debt, the global money supply would shrink by 2/3, trade would stop, the system would seize. Debt can't be eliminated, it's structural, necessary by design. Who profits? The institutions that hold the debt: BlackRock, Vanguard, State Street, Fidelity. These asset managers control tens of trillions, buying government bonds with other people's money, pension funds, retirement accounts, insurance premiums, and collecting the interest. That $1 trillion per year in US debt interest alone, plus interest from Japan, Europe, and everywhere, flows from taxpayers to bondholders. It's the largest wealth transfer in history, continuous, structural, and invisible to most people. It's not called a tax, it's called debt service. Workers pay, institutions collect, debt never decreases. Here's the final piece. The four architects didn't conspire together, they lived in different centuries, but each solved a problem in a way that benefited bankers, and each built on the previous one. Paterson made debt permanent in 1694, Rothschild made it global in 1815, Morgan made it infinite in 1913, Volcker made it inescapable in 1982. Together they built a system where governments borrow forever and pay interest eternally. The people who control the bonds, manage the debt, and collect the interest are the ultimate beneficiaries, not governments, not taxpayers, but the financial institutions. Here's the final truth. $38 trillion isn't a crisis for them, it's a business model. Every dollar of debt is an asset on someone's balance sheet. It pays interest, it provides collateral for more borrowing. And as long as confidence holds, as long as people believe the government will pay interest, even if it never repays the principal, the system functions, the debt trap is complete, escape isn't possible, not without collapsing the entire financial system. 4 architects, 3 centuries, 1 system. And everyone on Earth is now caught inside it. If this changed how you see government debt, if you finally understand that $38 trillion isn't an accident or mistake, but a system working exactly as designed, then you're starting to see how power really works. Subscribe if you want to understand how the machine was built and who's operating it, because they're not going to teach you this in school. They'll teach you debt is a problem to solve, but the architects knew better. Debt isn't a problem, it's the foundation, and interest is the rent we pay to live in their system.